Next up, Brandon Quinn. Brandon, thank you so much for joining us this morning.
Thank you. All right. Yeah, thanks again to BCI for organising this event. It's always a pleasure. My name's Brandon Quinn. I'm the CIO of Saffron Wealth. We're a Category 2A hedge fund company based out of Stellenbosch. I have the privilege of leading a great team of predominantly younger individuals than myself. We're an active manager. We utilize quant-based strategies to try and unlock value for you across a number of both fixed income, hedge fund, as well as equity strategies. So on the fixed income side, we've got our Opportunity Income Fund, which is the low-risk income-based proposition. We've got our Active Bond Fund, which is a very active long-duration fund. I urge you to have a look at that. We've got our Global Enhanced Income Fund in Ireland, which is a dollar-based cash-enhanced income fund. And of course, we've got our Flexible Fund, which is an equity fund that uses the concept of portable alpha to enhance returns. And that Flexible Fund has now been running for 3 years, and I think we've attracted about 670 million already into that fund. So in equity space, I think it's doing pretty well. So from where does the rubber hit the road with regard to our quant strategies? How do our quant strategies stack up against both our competitors and the market? And of course, the only real measure is risk-adjusted returns. So if we have a look at the risk-adjusted returns of our Opportunity Income Fund, you can see that it stacks up very, very well. And this is over a 10-year period. So why do I bring up long-term track records? Well, because Saffron has been, our funds have been around, or the majority of them, for more than 15 years, which means that we've managed our investors' money through cycles. We've managed through, exceptionally good times as well as exceptionally bad times, specifically in emerging markets. And our numbers stack up on a risk-adjusted basis. Our Active Bond Fund in particular is interesting because from a volatility point of view, we deliver superior returns at almost half the level of standard deviation or volatility over a very long period of time. So that really is where we think the rubber hits the road. Both funds right now have very attractive yields. Our income fund has returned about 10.3%, and that's in our 100 basis point fee class. And our bond fund over 1 year is sitting at about almost 15% after fees. So I think both pretty good returns over the short term as well. In the global space, you can see there again a significantly enhanced yield, and that's our global fund sitting at almost 6% over a 2-year period, and at about 0.75% volatility. So that's definitely 0.75% vol for a 6% after fees dollar return is a very attractive proposition. One of the key things that's important to realize with regard to our funds is we don't have any private credit. Why don't we have any private credit? Because of the liquidity constraints of private credit. All of our funds are incredibly liquid. And given the recent events in South Africa, we're even more convinced that this is the right way of managing money. Let's call it a 7, I think that's a 4 or 5 liquidity day period, about 80% of our fund can be liquidated. So that means that literally we can convert 80% of our fund into hard cash within about 5 days. So that very much is a hedge fund approach to the management of money. We are here today to talk about bonds, so I'm going to talk briefly about the tailwinds and the headwinds that are facing the South African domestic fixed income market. I think from a tailwind point of view, we definitely are in a cutting cycle, both domestically and in the US. Dollar weakness or rand strength. Is it really rand strength? No, it's not. The rand is not strong, the dollar is weak. That really is a key differentiator. And as a result of that, The rand strength has obviously resulted in better inflation numbers, and of course, to some degree, improved terms of trade. But really, it's not about rand strength, it's about dollar weakness. In terms of tailwinds, there's definitely excessive demand for global emerging market credit and emerging market sovereign debt. From a supply point of view, it's like we envisage that the central bank of SARB, or Treasury rather, is likely to decrease longer-dated credit bond issuance, and in fact focus more on the short end of the yield curve. And that would make sense because our yield curve is so steep. So in order to minimize the cost of funds, there's obviously a tendency to focus on the cheaper part of the yield curve, which is the short end. And that we think is going to play very nicely into our bond returns. Inflation targeting, frankly, I think it's completely inappropriate. Where we've got unemployment where it is, where we've got growth where it is in South Africa, I think that inflation targeting, which by definition means that you have to be keeping interest rates higher for longer, is growth inhibitive. And I don't see that as being appropriate for our economy right now. Another tailwind, and this, of course, is one of the lowest probabilities, that's why it's last on the list, is, of course, a surprise event coming out of China. China has embarked on a couple of really large stimulus packages over the last, call it, year and a half, 2 years. They haven't really done much. There's still a tremendous hole in the Chinese property market, but there's the potential for an outlier to surprise us there, in particular in the base and industrial metals complex, which South Africa is so dependent on. Headwind, obviously it's a lot of, let's call it government or administrative mismanagement. We've seen that in the form of the NERSA adjustments, which is constantly putting pressure on consumers and consumer spending in South Africa. The current weak Chinese market is still a detractor. And of course, our deteriorating SA political environment, but we don't need to go into too much detail on that. We all know that all too well. From a quant's point of view, it's really worthwhile taking or giving a revisitation of the real drivers of our bond market. And here we run a live what we call, or what is called, a factor analysis. And you can see there, I hope it's clear, is the 2, 5, 10, and 30-year points on our yield curve. And what we do is we try and understand what are the main drivers of each point on that yield curve. Because, of course, taking a position in a bond market is about two things. It's about shape and level. So it's important to divide up the curve and to understand what are the drivers of each component of the yield curve. The red bars indicate the repo rate. So that is the component that is controlled by the SARB. And you can see that it diminishes over time. In the short end, it comprises about 67%, or explains about 67% of the movement in the short end of the curve, and it diminishes all the way down to 24% in the 30-year part of the yield curve. What's important in the long end of the yield curve, and the long end of the yield curve is of particular importance. Why? Because it's the most of the duration on the All-B index actually is in the long end. It's disproportionately here. And you can see that 74% of the 30-year, the South African 30-year point, can be explained by movements in the US 10-year. So it means that you need to focus on what's going on in the US to understand 74% of the movements in the SA 10-year. And I'll get back to that shortly. If we cut to the chase in terms of what our expectations are with regard to the South African bond market, what we do is we take the All Bond Index and we stress test it to understand what the return dynamics are of the All-B. Given the fact that we are in a rate cutting cycle, and we saw that the central bank or the Fed cut rates by 0.25% last night, South Africa is probably likely to do the same. The forward rate curve also indicates significant further cuts likely to eventuate. If we assume a 100 basis point cut or cuts over the next year, what would the return of the All Bond Index be? And the return of the all bond index would be 15.5%, which is a tremendous return given the fact that inflation is only sitting at about 4%, which gives you an 11% real yield. So our view right now is that you have to really have a high degree of commitment in other asset classes that will exceed an 11% real return over the next year. So bonds for us are an incredibly attractive asset class to be in. If, for example, we only get 50 basis point cuts, and bearing in mind that we wrote this presentation almost a month ago, so it's somewhat outdated already, 50 basis point cut would result in a 12.5% return on a one-year basis. So those are very, very attractive yields that we think our domestic bond market can offer you. This is basically just telling you or demonstrating what I've already spoken about, which is that there were when I wrote this, was about 4.5% worth of cuts, 4.5 rate cuts of 25 basis points each, priced into the US market. So definitely in a rate cutting cycle, but certainly it's not immediate. This is over a 2-year period. So it seems like the market is expecting a protracted rate cutting cycle. If we look at US inflation expectations, previous speakers have said yes, that there's, it has been rising. But what's interesting is the Fed doesn't need inflation to be at the 2% target rate in order to cut. In fact, it's very rare that they cut at that 2% level. The Fed is more interested, frankly, in growth and employment. And this is really the crux of why the Fed cut rates by 25 basis points last night. The US employment rate, obviously, or unemployment rate has started lifting. If we look at labor force participation, so this is the number or the percentage of potential potential employees that can work or that are working versus that can work, and that's about 62%. So only 62% of the labor force is actually working in the US, and that has somewhat diminished over the recent past. I know I'm running out of time here. I've got 44 seconds, Eugene, so I know you're watching that clock. Importantly, if we think about the labor market concerns, this really, I think, captures where the Fed's mindset is right now. If we look at 2023 and the labor market in 2023, you can see there is the first release, the dotted line, and the final revision is the solid line. So that's 2023, that's 2024, and the red is 2025. In 2023, there were 252,000 jobs that didn't exist, that were measured with the first print, and that were revised to not exist thereafter. In 2024, there were 241,000 jobs in the US that didn't exist, that they thought existed. This year, and bearing in mind that we are at a much lower trajectory to start with, there are 461,000 jobs that were measured that don't exist. So the Fed is concerned on a couple of levels. Number one, the absolute level has been diminishing, and number two, the growth in the error factor has grown exponentially. So their confidence in the labor number has diminished. If we're thinking of South African bonds, yes, we're going to get a 25 basis point cut tonight. I'm pretty sure of that. We obviously have to be careful of the fact that if we cut our rates too much, our carry rate diminishes and our rand weakens. If our rand weakens, energy imports become more expensive, and that puts pressure on our inflation. So I know I'm out of time, so I'm going to rush through here, bearing in mind that the SA currency is mainly a metal story. So it's about iron ore, it's about precious metals, and of course industrial metals. Credit spreads, too tight. We think credit spreads are too tight for our liking. I know previous speakers have spoken about South Africa being fairly priced. We believe it's too expensive. and we've been on a reducing trajectory for at least a year now. So slowly but surely allowing our assets to mature. We think that there's going to be better value in the future than is currently shown in the markets. That's our carry rate. And then I think just to round things off and recap, a 100 basis point decrease in rates, 15.5%. That's our all bond curve. If we get 50, you're going to get 12.5. That's just the maths. Thank you.